At first glance, there's a lot of information in this question, so let's use this little trick where we read the last part of the question to figure out what we're focused on. And the last sentence is even rather big, so let's go to the second half of the last sentence, which says, what impact will an adjustment have on Jumpstart's year 5 net income? Well, an adjustment to net income, that means we're going to be focusing on an adjusting entry. So basically, the audit team, they probably identified an error or some sort of misstatement, and we need to propose an adjusting entry, but we need to understand what that entry is to figure out what the impact to net income would be. All right, so going back to the top, it says during the year 5 audit of Jumpstart Corp, which we already know, the audit team identified a $200,000 sale that was recorded on December 28th, year 5. All right, so they recognized $200,000 of revenue in the year 5 financial statement. Now, this sale must have been tested because when the audit team looked at the invoice and any other information provided by management, the audit team said, okay, this actually should have been recorded and recognized as revenue on January 5th, year 6. So we have a cutoff issue. They basically recorded this transaction in the wrong period. So revenue is wrong. We got to assume that there's some cost of goods sold related to this transaction that were also recognized in year 5 that we'll need to reverse. And they tell us that in the next sentence. It says, assuming that cost of goods sold related to the transaction amounted to $140,000 and that the misstatement is material, what impact will this adjustment have on Jumpstart's year 5 net income? So now we have the big picture. Let's go ahead and start with what the original entry would have been on December 28th, year 5. So as we can see, this original entry, well, if the sale was for $200,000 and cost of goods sold was $140,000. Well, we can see that we would go ahead and credit revenue for $200,000 and debit cost of goods sold for $140,000. Right? We also have to record the receivable. It could have been cash, but we'll assume it's an accounts receivable balance of $200,000. And then we also got to remove inventory, which matches that cost of goods sold of $140,000. So looking at this, right, the impact of the income statement or net income for year 5 was a positive $60,000 for this transaction. Now, since it's in the wrong period, we could stop there and go, okay, if we reverse this clearly, net income will go down by $60,000. Now, in this situation, the adjusting entry to propose by the audit team, it's not that difficult, right? When we have a cutoff adjustment, and that just means that they recorded it in the improper period, well, the year 5 impact would just be to reverse that transaction. Right now, they would record a separate one in year 6, but specifically for year 5 to adjust the financial statements, we just need to reverse it, right? So we're going to remove the revenue, add back the inventory, then remove the receivable, and remove the cost of goods sold. It's like the transaction never happened. We're putting basically everything back in inventory. Well, clearly, if revenue is declining by $200,000, but we get some benefits by removing cost of goods sold, well, the net impact there is a $60,000 decrease, right? We initially recognized $60,000 to net income. Now we're removing it. So this misstatement, the impact an adjustment will have on the year 5 net income is to decrease it by $60,000. Now, we could have skipped all the journal entries, but I wanted to focus on what the journal entry would initially have been and what the adjusting entry that the audit team would propose would be, because they could ask you about any aspect of this. And this is super common because a lot of audit teams will focus on sales transactions around the cutoff date. Why is that? Well, there's a higher risk of fraud because, hey, if the company does better and they need to meet some sales targets, they might recognize a transaction early, right? So that's why we can focus on cutoff right before and after year end to determine, okay, was there any sales transactions recorded in the wrong period, right? But again, for this question, we only need to know the impact to net income, and that was a decrease by $60,000, so that's the correct answer.